Stephen Furness here, Director of MGD Wealth, and in today's capacity, Chair of the LDI Connect Asset Management Investment Committee. And I'm really pleased to be joined by Steve Kempler, who's co-founder and portfolio manager at Maple-Brown Abbott, and one of the key contributors to the running of the large global listed infrastructure fund. Welcome, Stephen.
Thanks, Stephen. Pleasure to be here and good to connect again.
Yes, for sure. Now, background, Maple-Brown Abbott and obviously the global listed infrastructure fund is a key holding within the LDI Connect portfolios and has been for quite a few years. Today is a part of our ongoing commitment to the Meet the Manager series of investor education videos to give our clients, investors in LDI Connect, a good feeling for underlying managers, specialist managers that we use. So appreciate your time today, Stephen. Just a reminder, this is general advice only. This is not to be construed as any personal advice. It's information only. And as always, we encourage clients and investors to seek their own personal advice on any issues that might crop up today. So yeah, thanks again, Stephen. Good chance to have a chat about the Global Listed Infrastructure Fund. And obviously it's been performing really strongly lately, which we certainly appreciate. And yeah, so things are going well. In context, we LDI Connect through our major asset consulting partner WTW. We have both really high quality unlisted infrastructure investments, and Maple-Brown Abbott's our key listed infrastructure manager. So just from an education point of view, what is listed infrastructure fund? How big is the opportunity set, etc., Steve?
Yeah, thanks for that introduction. In terms of global listed infrastructure, it's a large universe. We invest in companies from all around the world, from a universe more than $3 trillion in size. So a big opportunity to get exposure to what we think as being core infrastructure assets around the world that offer investors with a strong combination of inflation protection and low cash flow volatility to equity through time. The fund has been operating now for about 12 and a half years at Maple-Brown Abbott, and we pretty pleased with performance over that period of time, delivering more than 12% per annum and net to investors after fees over a couple of market cycles now. The fund in the Australian market has about $1.2 billion today in it, and separately we manage accounts elsewhere in the world as well.
Yes, it's going very well, and yeah. Well, you mentioned the 12%. Obviously, it's relative to competitors and the index, but you've been a first quartile or second quartile manager pretty much the entire time, from what I can tell, which is good. You're at the top end of the league tables, I guess, in terms of competitive positioning and significant performance value add over index. Along that journey, which is good to see. So well done.
Thank you.
Now I have noticed that your underlying portfolio is compared to index and many other competitors have got a higher weighting to European companies than the US. You've still got a significant US weighting, but it's a bit more evenly balanced than many others. Do you talk through that?
Yeah, it's a good question. And when we build our portfolios, we're very much building them from the bottom up. We're a high conviction manager. We're looking for the best infrastructure opportunities globally at any point in time. So you'll typically see 25 to 35 companies in the portfolio. And the portfolio construction approach is somewhat completely benchmark agnostic. We do have a top-down risk overlay, which ensures we aren't taking any unintended macroeconomic bets, but with regards to positioning versus the various infrastructure indices, we're less focused on what the overall allocation is to specific markets compared to those indices. At this point in the cycle, we do have a decent exposure to the US. It's nearly 40% of the portfolio, but that is, as you point out, certainly a lot less than competitors, and a lot less than you see in some of the key infrastructure benchmarks like the FTSE 50/50 index. We do see good opportunities in the US today. They're mostly focused on electric utility assets, specifically electricity transmission and distribution infrastructure, as well as communication infrastructure, so mobile towers, cell towers, as they are over there. But at this point in the cycle, as you rightly point out, we do have a decent allocation in Europe and the UK. So within our broader European exposure, a big component of that for the last 12 to 24 months has been in the UK, specifically regulated infrastructure in the UK. There are 4 companies there, of which 2 are in the electric space, so electricity transmission assets mostly, and 2 are UK water companies. The larger of the 2 being a company called Severn Trent, which is based in the UK Midlands, and that sector is for the last couple of years gone through a bit of a tumultuous time from a political and regulatory perspective. But within that context, we've seen an opportunity to invest in companies that are trading significantly below their intrinsic value because of short-term market dislocations caused by factors beyond the perimeters of their own businesses. So that's been a nice tailwind for performance today. We continue to maintain those positions as we see further upside as they commence this regulatory cycle for the next 5 years. But that's a big part of that European investment that we have. The other component are in things like concession infrastructure assets. So we've had some big weightings in toll roads over the years and rail in terms of the Channel Tunnel, which I think we've talked about before to you and your investors in past conversations. But on the road side as well, we've had a big position in a company called Ferrovial, which is a large toll road operator, and that we've seen also for very stock-specific reasons, pretty significant upside, and that's been part of the return that you've seen for the last few years for the portfolio.
Yeah, and you were noting offline before we got started that there'd become some joint venture or some sort of agreement with Transurban on toll road side of things.
Yeah, so I guess for listeners in the Australian market, you'd be very familiar with Transurban here, who operate toll roads in Brisbane, Sydney, Melbourne, and a few other smaller places around the world. Recently, a few months ago, Transurban and Ferrovial's US entity, Sintra, have entered into a partnership approach where they're going to explore projects together in the US, and that really comes from the perspective of Transurban, having balance sheet size and experience in the road sector, and I guess past experience in the US, but no material presence at this point in time relative to what they've been in the past, and Ferrovial having the greenfield expertise in a number of markets where they've built what are called managed lane or express lane assets, which is where the real opportunity is for both of them for the years ahead in the market. And so teaming up together to pursue some of those opportunities in select US states.
Very good. Just looking at the year-by-year performance tracking and lots of asset classes. The COVID year, the 2020, was bit of a challenge for lots of investors, right? On very unusual times. But just, the listed infrastructure fund was down for the year, but probably nowhere near many other asset classes like pure equities and stuff. You've been navigating that period, and maybe some comments, and then we've had political uncertainty, policy uncertainty around the world. Recently, interest rates coming and going, and inflation coming off. How do you manage an infrastructure portfolio with that level of uncertainty in the last sort of 3 or 4 years on some of those things?
Maybe we'll unpack that into the two components. Just tackle the COVID piece first, and then talk about some of those nearer-term thematics as well when it comes to portfolio construction. I think we were somewhat fortunate entering 2020 because from an investment process perspective, as I alluded to earlier, very much bottom-up investors in nature. And as we entered the back end of 2019, valuations for a lot of the airport and road assets that we had in our portfolio had become more and more stretched over time. And so through the back end of 2019, early 2020, we'd taken a real knife to our airport positions. Good companies, good investments, but the valuations had largely reached our share prices largely reached our valuations. And so we entered 2020 with pretty minimal exposure to airports, which in the context of global lockdowns, global air travel ceasing, people stopping driving, that kind of helped. Now, all infrastructure was impacted by the pandemic in a material way, but some more than others. And for valuation reasons, we were in a position where we had lesser of that in the portfolio over 2020. Now, as the pandemic went on, a lot of these companies were impacted in terms of share price drawdowns a lot more than what the valuations would entail. And over the subsequent 12 to 24 months, you would have seen us adding back to some of those concession infrastructure assets, especially toll roads, where over the sort of 2 years following the pandemic hit, we brought them up to about 20% of the portfolio. And that's all really about our investment process, our stock ranking process, looking for valuation opportunities and balancing those with some of the quality or risk factors that we have in our portfolio construction approach, where we do continue to always tilt the portfolio to companies that have stronger inflation protection than average, that have lower cash flow volatility, which means more predictability in those cash flows, and a stronger corporate sustainability and governance. And that really extends through multiple market cycles. So that helped us navigate the pandemic. When stocks became unfairly hit, there were opportunities to rotate quite significantly. We are an active manager, and that has really been part of that alpha that you've seen post-pandemic 2021, 22, and again more recently. I guess maybe tackling the second part of the question, I think if we think more recent times, it's been an interesting year to date. If we just start with some of those thematics that you mentioned, just thinking back to the question, it's obviously been a lot of geopolitical uncertainty in the last 6 months. You've had continuation of the Russia-Ukraine war. You've had pretty significant tensions in and around the Middle East. War on multiple fronts in the Middle East as well. Inflation seems to be a bit stickier again. There's been greater volatility around interest rates. There's been fiscal deficit concerns, especially in the US. There's been political shifts following a change in president. You've had tariffs, you've had supply chain concerns and disruptions, potential tax changes. It's just been non-stop for investors. Yeah. And I think what has been interesting through that time, and even leading into 2025, with the uncertainty of what the administration change in the US would bring, it's been, I guess, a good place for this asset class. The asset class is very disconnected from economic cycles, and I guess in that paradigm, the asset class has probably proven itself not just to be resilient, but demonstrated a lot of those characteristics that I think investors really have historically looked for when they allocate to infrastructure as part of a broader portfolio. So I think that's been good. Our performance with it has been really strong, and thinking back to portfolio construction again, the entry price, the valuation of the companies that we buy in the portfolio are going to be, over the medium term, one of the biggest drivers of actual realized returns to investors. And as long as we can continue to shift the portfolio to places that we see value, then that will drive returns. Been probably a few key thematics over the last 12 to 24 months, and even through this calendar year that have helped. There's been the inflation tailwind feeding a lot of those inflation-protected assets I mentioned earlier. So roads have been a big contributor to performance. We all get probably frustrated that we pay higher tolls every quarter or year on the roads we all drive in Brisbane and Sydney and elsewhere in Australia. But that's been a nice tailwind for our investments. And we've seen that across other sectors. We've seen AI, whilst we don't invest in AI, we've seen that as a big tailwind for the electric utilities we invest in as well. And those thematics are really touching infrastructure, really at the heart of future investment needs too. So it's been an interesting time for the asset class. Performance has delivered over multiple market cycles, with the exception of 2020, of course. But all those disruptive effects around the macroeconomic piece have largely been unseen within what we're investing in.
Wow, you're doing well. The results indicate, and we really enjoy our relationship. You're doing a really good job. So well done, and keep it up. And it does serve, in wrapping up, that properly constructed, well-diversified, portfolios isn't just about investing in the listed equity markets, right? It's the role that investments like your listed infrastructure fund, the role they play is super critical. So appreciate your time today, Steve. Thank you, and always good to catch up, and no doubt we'll catch up again down the track. So.
Excellent. Thanks, Stephen. Thanks for having me. It's been a pleasure chatting, and all the best for the second half of 2025.
Yeah, totally. All right. Thank you. Thank you, everyone.
Right. Thanks a lot.
We'll catch up again soon. Cheers.
Bye-bye.